Mr. Buffett, Mr. Munger, my name is John Shane. I'm from Nashville, Tennessee. You touched on the subject of return on equity in response to a different question. I wonder whether you might be willing to elaborate along the following line. Right now, the Standard & Poor's 500 in aggregate have a return on equity of about 22%. The average over the decades for corporate America has been more like 12 or 13%. How did we get to this point of extraordinary profitability, and how likely do you think we are over the next 10 or 15 years to revert back to the mean of the low teens?
Well, I would say this. I never thought it would happen. So I start out with the fact that if you'd listened to me, you'd have been dead wrong if in terms of what the return on equity in 1996 or 1995, 1997 would be. It does not seem to me that 22% returns on equity are sustainable in a world where the long-term interest rate is 7%, and where the capability of saving large amounts in the economy are quite dramatic. You would just think that there would be some sort of leveling effect between 7 and the 22 you name, that as savings got directed within the economy and as the competitive forces operate that we've been taught will operate over time, would come into play. But I've been wrong on that subject, and that's why I say these levels are not unjustified if those kinds of returns can be made. Because let's just say that you had a 22% perpetual bond, and you had the ability, and let's say that a third of that coupon would be paid out. So you got a bond with a 22% coupon, and say 7% is paid out, being the dividend payout on the S&P, we'll say, and the other 15% is reinvested in more 22% bonds with similar characteristics. Now, what's that instrument worth on a present value basis in a 7% world? It's worth a lot of money. In fact, it's worth so much money that it becomes a mathematical fallacy at some point, because when the compound rate becomes higher than the discount rate, you get into infinite numbers, or you get into infinity, and that's a number. That's the concept we like to think about around Berkshire. We haven't figured out how to attain it. There's a book called The Petersburg Paradox, or there's an article called The Petersburg Paradox and the Growth Stock Fallacy. I think that's the name of it, by a fellow named, I think, David Duran, written about 25 years ago. And it gets into this bit where the growth rate is higher than the discount rate. And it shouldn't work for an extended period of time, but it's sure fun while it's going on. Charlie?
Yeah, I think a couple of things contributed to this phenomenon that we so carefully mispredicted. Number one, it became very fashionable for corporations to buy in shares, and I think that we helped in a very small way bring on that enlightenment, and I think that was a plus in terms of rational corporate decision making. The other thing that happened is that the antitrust administration got way more lenient in allowing people to buy competitors, and I think those two factors helped raise returns on capital in the United States. And but that can't, you wouldn't think that could go on forever. And what 15% per annum compounded will do is grow way faster than the economy can grow, way faster than aggregate profits can grow over a long pull. So sooner or later, something has to happen. I don't think we've reached a new order of things where the laws of mathematics are somehow repealed.
If real output in this country grows at, say, 3% a year, call it real GDP grows at 3% a year, and the capitalized value of industry in the country grows at 10% a year, at some point you get into mathematical absurdities. I mean, at the low inflation rates, You can't have if we have an economy that's 7 or 8 trillion now in GDP and 7 or 8 trillion in equity valuation, that may or may not make sense. But if you have one that's 15 billion in GDP and 75 billion in equity valuation, 75 trillion in equity valuation, you get to things that can't make any sense. So if you get these differential rates of growth among items that have some relationship, however tenuous, or at least non-specific in the short run, it doesn't work after a while. And nobody wants to think about that. They don't want to think about their own death. But I mean, it doesn't go away just because you don't want to think about it. And we haven't gotten any point like that. But you can project out numbers, and they just won't make any sense after a while.
Yeah, corporate profits can't be 200% of GNP.
Yeah.
Indeed, they can't be 50% of GNP. So these high rates of compounding just go automatically into absurdity.
Yeah, they really can't be 20% of GDP or some number like that. So if you start saying you can't have a multiple of more, you get differential rates, and they just simply you leave the tracks after a while.
And all you people should be aware of this, because all the people who are professional sellers of investment advice and brokerage service, et cetera, have an immense vested interest in believing that things that can't be true are true.
Yeah,
and not only that, they've been selected in a Darwinian process to have formidable sales skills and large energy. And this is dangerous to the rest of us.
Yeah. Well, you've been selected to be the recipients of their advice.
Right. Furthermore, they figure out who we are and come in about 6 o'clock in the evening.
Zone 1 again.